In today's volatile financial landscape, there's growing concern about the stability of the global monetary system, particularly the fate of the U.S. dollar. As central banks continue their aggressive monetary policies, experts warn of an impending crisis that could occur as early as this year. The prudent investor must be prepared, and that means securing enough gold and silver to weather the storm that may follow a potential collapse of the dollar. While such predictions have been made for years without fruition, the current economic indicators suggest we are closer than ever before to a seismic shift in the world's monetary order. To understand why precious metals, particularly gold and silver, are crucial in times of crisis, it's essential to differentiate between the different types of demand in the silver market. Investors often confuse investment demand with monetary demand, but the distinction is critical. Investment demand is what we typically see from silver stalkers and enthusiasts who buy silver in anticipation of its rising value. They are driven by the expectation that the existing financial system is unsustainable and that silver will be a safe haven when things go awry. However, monetary demand is fundamentally different and far more significant. It arises when people start to see silver not just as an investment, but as actual money, a medium of exchange for goods and services. This shift occurs during monetary crises, when traditional currencies lose their value rapidly, and people need a stable store of wealth. Unlike industrial demand, where silver is used in electronics, medical equipment, and solar panels, monetary demand is driven by the need for a reliable form of money, especially when faith in fiat currencies erodes. The gold-to-silver ratio is a key indicator of how the market perceives these metals during times of economic turmoil. Historically, this ratio has fallen to around 15:1 during periods of monetary panic, a sharp contrast to the current levels of over 70:1. In simpler terms, when fear grips the markets, silver tends to outperform gold because it becomes the more accessible choice for the masses who cannot afford gold. This pattern has repeated itself time and again in 1918 during the aftermath of World War I, and in 1980 amid the inflationary crisis that shook the U.S. economy. Both times the ratio plummeted as investors and the general public rushed into silver. Today, we are seeing early signs of a similar shift. Although the gold-to-silver ratio remains elevated, the cracks in the monetary system are becoming more apparent, and savvy investors are beginning to position themselves for what they believe is an inevitable collapse. When the tipping point is reached, we can expect a rapid move towards the historical ratio, signaling a full-blown crisis where silver demand outstrips supply. Many people are concerned about rising prices and inflation, but few understand the root cause of this phenomenon. It's not a problem of supply shortages or disrupted supply chains, it's a money problem. Inflation is often portrayed as a result of increased demand for goods, but in reality, it stems from the excessive printing of money by central banks. When more money is injected into the economy without a corresponding increase in the production of goods and services, the value of each dollar diminishes, leading to higher prices. In any hyperinflationary scenario, we see a predictable pattern. The prices of basic necessities like food, fuel, and shelter rise the fastest, while luxury goods either see minimal price increases or even decline in value. This divergence highlights a key aspect of monetary crises. The erosion of purchasing power hits the essentials first, forcing people to allocate a larger portion of their income towards survival. The current financial landscape shows clear signs that we are on the brink of a significant disruption. The analogy often used is that of the tide coming in and revealing who is naked. As economic conditions tighten, it becomes evident which institutions and entities have been taking excessive risks. We've already seen cracks forming on the edges of the financial system, with recent high-profile failures like the collapse of the UK pension funds and the implosion of major cryptocurrency exchanges such as FTX. These incidents are not isolated. They are early warning signals of a broader systemic crisis. The pressure on central banks to intervene will become overwhelming as more of these failures come to light. However, any attempts to reverse current policies and resume aggressive money printing will only exacerbate the problem. Once central banks pivot in the face of inflation, whether it's at 8%, 7%, or even 5%, we can expect a rush into precious metals. Historically, this is what investors do in times of uncertainty. They seek the stability of gold and silver as a hedge against monetary collapse. As the crisis deepens, the centralized stockpiles of silver, such as those held by the COMEX and LBMA, will come under immense pressure. These reserves are finite, and once they're depleted, the market will enter a frenzy. The same pattern was observed in July 2020 when the number of silver deliveries exceeded the registered supplies available, forcing banks like JP Morgan to move millions of ounces from eligible to registered categories in a desperate bid to meet demand. This scenario gives us a glimpse of what will happen when the registered supplies run dry, a mad scramble for whatever physical silver remains, driving prices skyward. The COMEX and similar futures exchanges have long been the primary venues for silver trading, but their influence is waning. In a true monetary crisis, when people lose faith in paper assets, the focus will shift to physical silver. At that point, the paper markets will become irrelevant, as investors demand real, tangible silver to exchange for goods and services. We've seen this before in past crises, when the physical market takes over, and the paper market is left behind, unable to satisfy the demand for actual metal. If this shift happens, it could spell the end for the dominance of paper-silver contracts. Instead of trading silver futures for dollars, we may see a decentralized market emerge, where physical coins and bullion are used directly for transactions. This would mark a return to a form of barter economy, where precious metals once again serve as money not by decree, but by necessity. The concept of gold and silver as money is not a new one. It dates back thousands of years. Throughout history, whenever a fiat currency has failed, societies have reverted to using precious metals. Unlike fiat currencies, which can be printed at will by central banks, gold and silver have intrinsic value. They are scarce, durable, and universally recognized as stores of wealth. While some have proposed the idea of a basket of commodities backing a new currency, such schemes have never succeeded in practice. Only gold and silver have consistently functioned as true money. Attempts to use alternative forms of money, such as real estate or agricultural products like tobacco, have always been short-lived. They lack the universal acceptance and stability that gold and silver provide. This is why any new currency, including a proposed BRICS currency, would need to be backed by gold and silver to gain trust and supplant the dollar. The idea of a commodity-backed currency may sound appealing in theory, but it's gold and silver that have stood the test of time. There has been much speculation about the potential of the BRICS nations, Brazil, Russia, India, China, and South Africa, to challenge the dominance of the US dollar with a new gold-backed currency. While this idea has gained traction in recent years, it's important to recognize the significant hurdles that lie ahead. For such a currency to succeed, it would require fiscal responsibility from the member nations, a quality that is in short supply. Countries like Russia may have the capacity to back their currency with gold, but other BRICS members like Brazil and India face significant fiscal challenges. Without a fundamental shift in their financial policies, it's unlikely that a BRICS currency would be stable or trustworthy enough to replace the dollar. Instead, what we are likely to see is the BRICS nations following market trends rather than leading them. When the dollar fails, they will have no choice but to adopt gold and silver as the foundation of their monetary system, taking credit for a move that is driven by market forces rather than proactive planning. One of the most common questions investors ask is when the collapse will occur. While it's impossible to predict the exact timing, all signs indicate that we are on the verge of a major shift. The current inflationary trajectory is unsustainable, and like all exponential trends, it will continue to accelerate until it reaches a breaking point. Central banks have temporarily halted their aggressive money printing, but this pause is unlikely to last. Every previous attempt to stop inflation through monetary tightening has ultimately failed, forcing a return to expansionary policies. We are now at the critical juncture where the system could break at any moment. The exponential growth in money supply has led us to the vertical phase of the curve, where the only outcomes are hyperinflation or a complete collapse of the existing financial structure. If central banks choose to continue their tightening measures, they risk triggering a cascade of bankruptcies among their own network of financial institutions. However, history has shown that, when faced with the choice between systemic collapse and further money printing, they will always choose the latter. Evil, as the saying goes, is inherently self-destructive. The greed and short-sightedness of those who control the monetary system have led us to this point, and they are unlikely to change course now. The Federal Reserve may attempt to stave off the collapse for a little longer, but the outcome is inevitable. When the reversal happens, it will be swift, and the rush into gold and silver will be unprecedented. We are witnessing the final stages of a dying monetary system, where fiat currencies are losing their value, and precious metals are reclaiming their role as true money. In the end, physical gold and silver will not just be stores of value, they will become the foundation of a new economic order. The transition will be chaotic and painful, but those who have prepared by accumulating tangible assets will be the ones who thrive. This is the endgame. We are facing a return to real money and the collapse of a financial system built on nothing but promises and debt. So be prepared. Stock up on gold and silver now, because when the dollar falls, it will be too late to act. This isn't a question of if, but when, and the prudent investor knows that time is running out,